From a top-down perspective, there are three intriguing data sets coming up, all interlinked. To rattle through them, on Tuesday the 8th of June, we have the NFIB Small Business Optimism Index in the USA. Small businesses, those with less than 500 employees, represent 99% of all American firms and account for 70% of American jobs, according to the 2019 US Census. So small companies really do matter. They're also a good guide as to how the American economy is doing. Now, this index rose in April to 99.8, but 44% of small businesses said they were struggling to find staff. We should also note that the April reading is well below the 2018 peak. So American firms seem to be saying, yes, we're in an upturn, but maybe not a roaring 20s style boom. Maybe that's one reason why America's small cap index, the Russell 2000, is no higher than it was back in February, and this is a trend to be watched. If small caps start to flounder, then sometimes big caps can follow. On the same day, Tuesday the 8th of June, we've got the latest Chinese inflation figures. They surprised on the upside last month with the consumer price index reading of 0.9% and a producer price index of 6.8%. Now, markets are on the lookout for signs of inflation. A rapid rebound helps to explain why small caps and cyclicals, or value stocks, once for a better turn of phrase, have outperformed growth and quality areas such as technology over the past few months. Then, on Thursday the 10th, we get the latest batch of American inflation data. Just like China, well, that came in higher than expected in April, as the consumer price index rose 4.2% year on year, the fastest gain in more than a decade, and producer prices surged by 6.2%. Now, this could just be the result of the low base caused by the pandemic in 2020 and early pent-up demand post-lockdowns. But sustained inflation, if it happens, could force central banks to tighten monetary policy, and such concerns may explain why headline equity indices the world over are finding it a bit harder to make progress. So economists, central bankers and investors alike will be poring over this data set. Back on the home front, we have a busy slate of scheduled corporate announcements across the range of large, mid and small caps. Names which may be worthy of note include the following, although do please bear in mind some of these dates are provisional and could be subject to change. S4 Capital on Monday the 7th of June, Intermediate Capital, Paragon Banking, RWS, Oxford Instruments and VP on the 8th, WPP and IP Group on the 9th, Auto Trader, Gamesys and Go Ahead Group on the 10th, and Warpaint London rounds off the week on Friday the 11th. But for all of those names, the company which could just cause the biggest fuss in the coming week is FTSE 100 member Halma. Now remember, this company provides a solution to a problem, in that its hazard detection and life protection systems, locks and devices help companies meet regulatory requirements and keep staff, clients and customers safe. The mandatory nature of investment in this area creates consistent business flows and sticky customers, a combination which gives Halma a degree of pricing power. That in turn can mean high margins, good returns on capital, strong free cash flow, and a growing dividend for investors over the long term. And it's Halma's dividend record that could be the source of any fuss this week. The analyst consensus forecast is for a full year payout of 17.32 pence a share, an increase of 5% on the distribution for the year to March 2020. Now, if this forecast is met, it would be Halma's 42nd consecutive increase in its annual dividend of 5% or more. It would also keep the Buckinghamshire headquartered company in the elite list of just 14 FTSE 100 firms that have managed to increase their annual dividend every year for the last decade. Now, on a share price of nearly £26 as I record this, the forecast dividend yield is around 0.7%, which might not thrill income hunters. But bear in mind that 10 years ago, the dividend was just 9.1 pence a share, and it's nearly doubled since. Moreover, 10 years ago, Halma's share price was 379p. So what would you have thought if someone had told you 10 years later the dividend would be 17.3p for an implied yield a decade later of 4.5%? I suspect you might have been a bit more interested, at least, certainly if income's your game. Now, please note that this is not investment advice with regard to Halma, by any means. But it does exemplify the power of dividend growth when it comes to capital returns as well as income when things work well. You now need to look at Halma's earnings cover for the dividend, cash flow and balance sheet, as well as its trading prospects, before you can decide whether that 40-plus year streak can continue. Now, at first glance, earnings cover looks healthy enough at more than 3 times, based upon the consensus forecast of 55.5 pence in adjusted earnings per share, compared to that dividend estimate of 17.32p. This chart here shows the historic earnings per share or EPS progression and dividend cover for the last decade, along with forecasts for the year just finished and the one just begun. Besides the dividend earnings per share numbers, analysts will look at the headline sales, operating margin and pre-tax profit figures. On a headline basis, the consensus sales forecast is £1.3 billion or pretty much flat. The organic rate of progress may be of more interest, and at the first half stage that was minus 11% on a constant currency basis. Analysts are expecting improved momentum in the second half. When it comes to the operating margin, Halma's management has a target of 18 to 22% on an adjusted basis, and at the first half stage, that figure was 20.6%. And for pre-tax profit, management guided to flat for the year just ended, against its prior estimate of down 5% in a recent trading update. That implies a figure of £267 million on an adjusted basis. For the year just begun, in the probably unlikely event that management feels able to give any guidance, consensus is looking for a 9% increase to £288 million. More strategically, watch out for updates on acquisitions as Halma uses select purchases to supplement its organic progress. Chief Executive Andrew Williams announced one purchase in the second half of last financial year, Static Systems for £37 million, and has kicked off the new financial year by snapping up American firm Perigen for £42 million. I hope that you and your families are all in good health and good spirits. Thank you for listening, and I look forward to talking to you again next week.